Risk management is at the heart of what we do. Our deep-rooted industry and technical expertise enables us to manage the unique risks your business faces.
Welcome back. We're discussing the risk exposures facing the short-term insurance industry, specifically about loss of property. Still with me in studio are George Bishop, the CEO of Willis Towers Watson South Africa, Belhassan Tonat, the General Manager of Munich Re of Africa Short-Term Insurance, Andrew Kutz, the Head of Intermediated Distribution at Santam, Bernie Ray, the CEO of Emerald Africa. And Bernie, I'd like to pick up with you. Is the industry taking a more proactive approach to risk management, and is this something that needs all players to collaborate on together?
Stephen, I think we are. Obviously, in the light of the events of 2017, both globally and in South Africa, the focus is on risk management. It is, however, something that we've been looking at for a number of years, and we've been managing to do it with a varying degree of success. Obviously, as an insurer, we very seldom get the opportunity of interacting directly with our policyholders, and that's when someone like George's company comes along and intermediates for us. And through their offices, we're able to interact with the client in terms of risk management. We at Emerald, for example, have our own internal risk management structures. We have an engineer employed who does surveys and assists clients in terms of their risk management. But we are not the risk managers on the ground. We are the insurers, and we rely very heavily on the intermediaries and the insureds to practice good risk management, of course with some advice from us.
So what sort of collaboration would there be, Andrew, between players?
So I think more and more we are seeing our dependency on good advice making a big difference. So
George's advice.
George's advice. Yeah. All good brokers' advice. And I think it's a good news for a story for the intermediate model, because at the end of the day, without good risk management advice, insurance can no longer stand alone and be that risk transfer mechanism. We've got to work as an industry to stop the risks happening wherever we can, so that there's a sustainable process to actually transfer some of the risk to the insurers and to the reinsurers. If we don't find that balance, there can become segments of the market that fundamentally just become uninsurable. So I think we're seeing more and more of that. I think we have industry bodies like the Financial Intermediary Association, the FIA. We have the South African Intermediary Association, SAIA, more and more collectively trying to find ways to share more, to communicate more about the importance of fundamentally accepting that risk on the ground has to be managed before it can just be transferred.
But of course, George, there can't be a one-size-fits-all model, so the risk management between Santam and Emerald, for instance, must be quite different. How do you approach that?
Well, I think the difference lies in the type of client that is buying insurance. So within Santam, there aren't the commercial buyers of insurance. They're more the personal insurance. The Knysna fire disaster would have been out of Santam, whereas in Bernie's business, that's where most of the large commercials or corporate accounts are placed. So there is a difference. I mean, the various risk management standards that need to be applied for the different types of exposures that those businesses face. There are different types of occupation, there are different industries and sectors within those industries. And then as we've said already this evening, what happened in Durban is a natural disaster event, storm damage, wind damage, as opposed to fire. It's very difficult to apply risk management standards to massive flooding in a very short space of time.
I think, George, if I could just add on to that, whilst it's a natural disaster and you'd think that an individual can do very little to prevent these things, there is a slightly bigger picture, and that is that what we find is in the built environment, if the municipality, for example, doesn't apply building standards correctly, or if your drain water reticulation systems, stormwater systems, as we've seen at up near Johannesburg near the airport, when the stormwater system was blocked, a relatively benign flood turned into a major event. So there are things that people can do. There are these systemic issues, and I know Santam works very, very hard together with municipalities throughout South Africa on such projects, both in terms of fire, flooding, and other systemic risks. And that's the kind of thing that is necessary. So it's not as though in a natural disaster humans could do nothing. But as limited as it may be, there is something that one can do, and really risk management should be at the forefront of everybody's minds. One of the examples from Knysna that I saw was amongst the debris and the blackened landscape that we saw, one lonely house stood without any fire damage at all. And this was simply because the owner of this particular property had decided that fire breaks were very important. Alien vegetation was cleaned away and that sort of thing. And when the fire came through, it was able to miss this particular house. So people are able to take, albeit small steps, in terms of mitigating the damage that they may suffer.
This must be an additional cost to Santam, though, when you're stepping in and helping municipalities and helping to augment fire services. Does it pay off for you, Andrew?
It's one of us, a great example of a good private-public partnership. So we've got an opportunity now to work with, identified with government, 51 municipalities, particularly around fire response and risk management around that. We're working aggressively with identified fire departments around equipment and firefighting equipment, etc., like that. We've now done training in informal settlements. With 20,000 people involved. We're putting smoke detection into those areas who typically don't have insurance cover as well, because there's a real opportunity to talk to the why of insurance and the value of insurance. Those who were insured and those who aren't sit very differently after an event like this. So, yes, there's a cost, but we get a real life bottom line impact, and also we get to add value and talk a little bit about insurance, not just about the grudge purchase up front, but the real value enabler about putting people back in homes and buildings back standing again and businesses back on the run. So it's a good time also to be in insurance. We talk about the losses, but we don't always talk about how much benefit we have been able to give to those clients who were well insured.
I think, sorry to interrupt, but I do fully agree with Andrew that actually such investments in post-fire or post-event mitigation measures do pay off actually in certain cases for insurance company as well as for reinsurance company. But even I think the role of the insurance industry goes even one step before that, so that we try to mitigate the losses. This is one of our main concerns, but also we try to prevent losses from not happening. And this is actually what we have seen in investing actually in preventive measures, so that we can actually play a role before a catastrophe or before a loss event happens. So, and one of the examples for what we can see nowadays is how can we make use of the new technologies to actually enhance our risk prevention measures. And one of them, for example, in the Internet of Things, so in houses, for example, if you put, and we are running a pilot example, for example, a pilot case in the United States, where we're going to put infrared cameras in certain houses to detect actually the heat variation, so that we can prevent a fire before it actually strikes. And this actually, it comes with even a reduction in the insurance premium of the household. So they get an upfront reduction from their premiums, whereas they are putting in place some risk prevention measures. And I do believe both actions, before the loss and after the loss, are very important from an insurance industry to play our societal roles actually in decreasing the number of losses and the impacts of the losses on the lives.
I mean, are your clients biting when it comes to risk prevention, George, when you approach them with things like these?
Yes, I mean, our clients are corporate-based clients. Many of them have formal, ongoing risk management programs involving huge capex that gets spent to improve their risk exposures. I mean, their businesses are growing and expanding, and risk management is following that expansion that enables their business to grow. So it's happening. I wouldn't say it's happening across the board. There are some buyers of insurance who can improve their risk their attitude and their commitment to risk management. And then when these tough times arrive, when the market wants to significantly increase the premium, those well-managed risks will renew their programs at lower pricing.
Okay, so it does pay off at the end of the day. I mean, obviously you can't foresee events like we have seen this year, Andrew. We were discussing off-air the confluence of factors that led to those events, and you described it at the beginning of the show. And you said it was actually all one event, the Western Cape and the Southern Cape. What difference does that make to an insurer, whether it's one event or two?
Yeah, so we typically would transfer a portion of risk. So we would have, in terms of our own balance sheet strength, an appetite to carry a certain amount of any catastrophe exposure that might happen, or individual risk event that might happen. So based on that, we will take what's called a deductible or an excess ourselves, and we pass on, we layer on the balance into our reinsurance programs. Where you have a cut like happened between the Western Cape storms and then the Knysna, which are all linked within a 2-day period of each other, 3-day period of each other, if that is one result of one weather event or one catastrophe, that deductible that we keep ourselves before paying over the risk is one event for us. So we only have to take, in our case, we take the first 100 million rand on a cat event. And in our case, that's it. If there were 2 events, we would take 200 million rand. And so the impact on your own balance sheet changes. So wherever there's an event that's one, obviously for us kind of thing, that means that we end up paying less of the first loss on those before we pass the balance into our reinsurance programs.
Okay.
So here I have to jump in, I think, and I have to disagree with Andrew on the fact that we see it as one event or 2 events. I think on the insurance industry, it's still debatable if it's 1 or 2 events. We know that the Knysna fires and the Western Cape, they are 300 kilometers away from each other. There are also certain, I would say, wordings which would limit the impact of reinsurance to a certain diameter, certain areas. But I think that's something which we can spend a lot of time to debate, and if it's 1 or 2 events. What I would like to add here is actually the role of the insurers and the reinsurers in certain cases. So in such circumstances where we do see the real value of insurance and reinsurance. So a lot of households or also commercial, actually after having suffered from these events, with the help of insurance companies, they could actually restart their business in the next few days and keep going and keep generating profits for their businesses. And this is actually what we should also emphasize when we set the insurance policies about when it comes to loss, and you have your insurance and your insurance to rely on to keep your business going.
Well, I think we can probably agree to disagree on whether it was 1 or 2
Exactly.
events. I'm sure we can all agree we wouldn't like to have a repeat of it. Gents, we have to leave it there. Thank you all very much.
Thank you. Thank you, Stephen.
That's where we have to leave the discussion for today. Thanks again to today's panellists, George Bishop, the CEO of Willis Towers Watson South Africa, Belhassan Tonat, the General Manager of Munich Re of Africa Short-Term Insurance, Andrew Coutts, the Head of Intermediated Distribution at Santam, and Bernie Ray, the CEO of Emerald Africa.
34 countries, 75 innovative risk solutions, 99 years of experience. It all adds up to being the largest general insurer in Africa.